So I'll just tell you a little bit about myself, which we kind of started already. My name is Jessie Williams, and I started my company. It's been started progressively throughout the years while I've worked for the Big Fours and PwC, Ernst and Young, and I just always done little stuff on the side. And up until 2 years ago, I quit my day job and went cold turkey and just started this. And
All right.
I moved in here almost a year now. I have my own office on the
all
12th
right.
floor. Yeah, so
All
I'm on the
right.
12th floor. So I decided to do these seminars on a monthly basis because there's a lot of entrepreneurs here, and I feel that on the financial side, people aren't educated financially. And I think is not hard. I think people's perspective and attitude towards numbers is ridiculous because some people just don't want to. They don't want to know. And I've seen that people who've making decent money on their business side, they just don't want to know, and it baffles me. And you have to know what each number on your tax return is. You should be able to explain every number, and and that starts with your accountant going through things with you. I think we live to do the tax return, but we don't know what's going in there. And, that's what kind of sparked this topic this month, budgeting. And that's really what it is. And I honed in on 5 things that I do think a lot of people get wrong when it comes to budgeting. Apart from their attitude towards budgeting or not having any at all, a lot of them, they, not setting goals. Goals could be so broad. I think it is impossible to just spend money. You gotta have your priorities in order. You need to have clear goals. It needs to be identified, and whether it's big or small, it needs to be clearly identified. It needs to be something that could be attainable. And how is it measured when you attain it? Is it measured in numbers? Is it measured in time? You can't just set a goal and say, hey, in 1 year, I want to reach this goal. Whether it comes out to dollars, you gotta ask yourself, and it has to be detailed. I like to work backwards. If I say, hey, this year I made, I'm just throwing a number, this is not true. This year I made $1 million in sales, just gross. Am I happy with that? Is that something I want to continue maintaining? Do I want to double that next year? And now I said, okay, yes, I've determined I want to double sales next year. What does that really mean once you boil it down to the details? Like, does it mean I have to take more calls? Does it mean I have to have more meetings? How many meetings did I have to generate the 1 million? And now I have to double that, obviously. Does that mean I need to have a bigger team? All that stuff, and budgeting and planning will go hand in hand. And there's some things that people just don't do. Another thing they don't do, they underestimate their cost. I do budgeting personally in my life, and I've mentioned that to a friend a couple of years ago, and he thought something was wrong with me financially. He's like, why do you have a budget? Are you a poor spender? I'm like, no, I can't swipe my card and not know if I have money, for that. I can't even swipe. A lot of people swipe credit cards, and they do it for points, which is nothing bad with that. But how do you know when you overspend on, I don't know, groceries or food, that type of thing? So a lot of people underestimate their costs for businesses. Like, you ever had a time where you purchase something and you budget $100? I'm like, okay, great, you're within your budget. But then you have all these other costs that come along with it. Like, there might be a surcharge, there might be a service fee, a convenience fee, it might be shipping. And some shippings are ridiculous. You might buy something for $5 and the shipping is $10. That has happened. So there's a lot of indirect costs, incidental costs. And the thing about when you put together a budget, I always tell people, start with the costs that won't go away. And these are your direct occurring costs. They're going to happen. And for us in this building, is one, our rent. It's never going to go up. It's never going to go down. If you're in a contract, you know exactly what it's going to be. That's the first thing. That's your biggest expense next to paying yourself. Have a set fee you pay yourself, put that down. And then from there, you have office stuff that you pay for. If you go to visit clients, you have, costs to travel. If you're having a lunch and learn, costs for food, stuff like that. And, even costs when you're having a good month. Because you ever had a great month, and the cash is there, extra $2,000, what are you going to do with that? Ask yourself, am I going to save half or do that advertising campaign that I always wanted to do? What are you going to do with that $2,000? And that's another cost that people don't think about. So I think, always putting everything down to a T, and it goes back to your financial life. How often you get a haircut? Put that down. How often do you, is getting your nails on a weekly basis important to you? Then that needs to be a cost that needs to be put down. Some people don't even think of little things like that. So just never underestimate your costs is one of the second biggest things people get wrong when it comes to budgeting, and forgetting about tax obligations. I've had mostly 90% of my clients would say to me, this is a true example. I have a client, S corporation. S corporations is a flow through. It trickles down to your personal, right? It's paying a salary. Let's say the business net $50,000. This person is shocked that they have to pay $3,000 in taxes. $3,000 is nothing compared to the $50,000 that you made all year and paid no taxes on. Now, that's just poor expectations. I think it's poor view on money, and I think it's poor planning. And it comes down to tax planning. You have to plan for your taxes. And it's very different from tax preparation. You cannot expect a person who you hired to do your taxes to do tax planning. It doesn't work that way. You have to, now is a good time to do tax planning in terms of, are you taking on all the expenses that you should have been taking throughout the year? Are you leaving money on the table in terms of expenses? What expenses are you doing personally for your business that you're taking on a personal size and not accounting for? Are you in the right structure? Should you stay in an S Corp or should you go to a C Corp? There are new tax laws. A C Corp is 21% of taxes, and sometimes if you pay yourself, let's say $100,000, now I'm quite sure you add a wife who's working, now you're making, close to $250 a year, and now your tax bracket just went up through the roof, and it's more than 21%. And now you have a flow through where an S Corp that's not paying taxes federal level, and now it just went, now you just spiked up your tax bracket because the business isn't paying any taxes, everything is flowing through to you, so now your tax rate might be 30%, whereas our president just gave us 21%. So that 10%, why not? I have a client, last year I looked at their tax return and they paid $2 million in taxes, and they had an S Corp. If they had switched over to a C Corp, they would have saved a minimum of $1 million in taxes. Half. Literally half.
How about B Corp? What is that?
Huh?
B Corporation?
A B Corporation?
Yeah, a benefit.
No.
It's like a social enterprise.
I never heard of a B Corporation.
Okay.
I heard, there's a C Corp, the S Corp is how you structure it in terms for tax purposes. A C Corporation, and that's your traditional corporation, and you have the S Corp. Maybe you're.
It's a relatively new.
They all are new stuff popping up, but you gotta ask yourself.
But I have no idea.
Right, because everyone, for instance, everyone is an LLC, right? But if you are a single member LLC or a multi-member LLC, now a multi-member LLC is a partnership for tax purposes, and a single member LLC is disregarded for tax purposes. You don't pay taxes. You're not considered an entity as a single member LLC. Everything now goes through you. You don't have a tax return per se.
Is that right?
That is very true, yeah. Oh. And a lot of people don't know that, So
no, I'm curious because I'm on the side. I'm developing a coaching practice.
Mm-hmm. Business coaching or athletic coaching?
No, life coaching.
Life coach.
Could be applied to
that's great.
Business or anything. But I'm not at a point where so these are the questions about the
structure and that's good. When you're starting something and you're trying to hey, let's get this official. What do you pick? And why? Sometimes something like that is really not like a big shebang as opposed to someone who later want to raise capital. Then I say then you definitely don't put it as an LLC, you put it as a C Corp. how you plan on raising funds. Do you want people to have equity, or do you want them to have? Do you want to take do you want to raise it as debt? So structuring stuff is very important. Another big thing that always trips people up is payroll taxes. You got payroll. You got withheld for the the employee, and for the employer yourself. And some of it you can't deduct. You can't deduct it, but people trip up with that, and they confuse payroll taxes with income taxes. I had a client who pays sales taxes, and he's like, "I just did sales taxes." I'm like, "That's income tax. It's two different things." So these are the three things that you could possibly, and also people forget about the local tax. Another thing too, if you're going to do S corp, the city of New York charges S corps. Everyone knows that.
What does the S stand for?
The S is, so basically, if you look at it as a corporation and you look at an LLC, S corp is in a nutshell the best of both worlds. It's still a corporation on its own, it's still a separate entity, but for federal purposes, it doesn't pay taxes. For the most part, for state, it doesn't, but some states treat an S corp differently. Just like LLC, some states treat it differently. So that's the next thing too. You're looking at the federal level. What does it mean for you state-wise and state and local? Is it better to incorporate in Jersey or New York? I live in New Jersey. Should I incorporate my business in Jersey?
Right, yeah.
Or should I do it in New York? Well, New York asks you to do all sorts of things, like you have to put a publication out as a requirement. I didn't want to do that, so I incorporated in New Jersey and work and have an office in New York. That's totally fine. So all that go into tax planning, which I do, by the way, and we had a whole seminar based on it, a one lunch that was based on tax planning, and it's something that keeps me busy throughout the year, so I'm always busy. So a fourth thing that people do, and we had a session on this with cash flows, people assume because they have revenue, they have cash, and it's not the case, because you send me an invoice, and I'm good for it, I'm gonna pay you, but then you give me this net 30 days thing, and I take advantage of the 30 days, and on your books you have the cash that I'm supposed to pay you, but you didn't collect it. And that's what we call like a cash gap between when you send an invoice to actually collecting it, and that gets a lot of people in trouble, because they know they're spending money that is coming in, but it hasn't hit yet. And then you shouldn't be spending money that you think is coming in. You could plan for it, but you don't know. What if I just decide I don't want to pay you? What if I end up being bankrupt within those 30 days? A lot could happen in 30 days. So knowing how long an invoice turns into cash is very good. You have to analyze your cash flow in terms of how quickly you're collecting and how quickly you're spending. So that's another thing that a lot of people don't think about, because, for instance, I bill my clients, bill is due the first of every month. I expect that when I send you an invoice, it should be paid that day. I expect that, because you knew what the expectations were. You've been paying this for the past 6 months. Why is it on the 15th of the month I still haven't collected? That's because, you're not managing your cash flow right. Because, so maybe you shouldn't send an invoice on the first of the month when it's due. Send it a week before, so they know it's paying on the first. And then what do you do on the second if they haven't paid you? Well, send an invoice again. That type of thing. Maybe set up a reoccurring plan with them. These are things you could do to lessen that gap as to when you get paid and so on and so forth. And failure to adjust your budget. You shouldn't be afraid to change stuff around. What if you lost a client who makes up 20% of your revenues? What do? Something that gets scaled back. If you don't scale anything back, use your cash reserves, your savings in the bank, stuff like that. Changes stuff. It's a continuous thing. Your budget shouldn't be static. You should look at, people say the basic thing, look at last year, bump it up, think about your goals, what you want to do, trim where you think should be trimmed, stuff like that. But your budget should also be rolling, and you should always compare your last year with actual budgets and where did you go wrong? Did I underestimate? Did I overspend? Did this come up? If this come up again, how could I, account for that? And that's pretty much it in a nutshell. And I summarize it here. These are the 5 common budget errors that people fall into, apart from just not having a budget altogether. And that's number one, really just not setting a goal. And that's the summary there. So we have all these things to be aware of. The question is, how do we start? Like, where do you even start? And I say, first start with your books. I ask people, how do you feel about your books, financial statements? What month are we in? We're in May. We had a full quarter just passed by. And if you ask yourself, how did I do in 2018? Was my books ready for taxes in February, in March? And if the answer is no, then why did it take you, 2 months to get your books together? Your books should be up to date once a month. Now, does stuff fall back? Yes, it does. But do you know what you grossed in 2018 off the top of your head? So these things, for the most part, as business owners, they should really know, and some just don't. How do you feel? And books, sometimes numbers, it could be emotional. So how do you feel about it? Does you get a pain in your stomach every time when you have to think about your books? Then, you need to change that one and get help. So that's the first place I say, tell people to start and really be honest with it. Do you feel like you have a handle on it, on tracking your revenues and expenses? Do you really think everything is being categorized and summarized correctly? That is the first place. And then your taxes, how do you feel about it? Some people don't want to think about it. They dread tax season because they know they're going to, then why? Let's manage that. Let's take out the planning. Let's take out the surprise of it and start planning and know the difference between tax planning and tax preparation. If you sign up for, I see your eyebrows. What's the difference, right? Tax planning is what we call tax compliance. We're just complying with whatever state that you're in the federal government. They tell us we gotta file a return, we file it. That's it. That's what you pay for. You're not paying for looking forward. So tax planning is what you do before. I wish we had a pen here. Tax planning is what we do before we start making money. And I have this diagram that I use all the time. I hope this is working. Where you have this little thing here, and then you have this here, and this is what you paid. This is what you want to pay, right? And then what's the difference? Planning, specifically tax planning. And this is like, if we're in May right now, and I could say, you know what? Let me look at your 2018 tax return. And if I change the structure from a C Corp to S Corp, that's just tax planning. I could tell you, if you do nothing, this is how much taxes you will make. If you do nothing, this is how much you will make. If you implement the strategies that I'll give you, this is how much you're gonna pay. And that's all in tax planning. You can't do anything at that once tax planning comes around. Taxes comes around. There's nothing you can do. You already did it. So like I said, start with your books.
Is that for federal or in state?
When I do tax planning strategies, I do for
No, the home office.
Oh yeah,
Is
it's federal, state. It's a legitimate business expense that you can take on the federal and the state. The second thing, set goals and work backwards. Where do you go with your numbers? So you have 2018 numbers, you should have it because you just did your tax returns a couple of weeks ago. So start with those numbers. Set your goals. Like, ask these questions like, do you want to pay yourself more? Some of us aren't paying ourselves, we're just taking money out as we need it, so we gotta get more structured. Do you even want to start paying yourself? What would that look like? So take a 2018 return and slap in there a salary for you. If you felt you was overwhelmed like I did, could you afford to have help? What does that number look like? Put in the taxes, the payroll withholding, put in their numbers. If you're selling stuff, you gotta collect sales tax. You gotta put that to the side and make sure you're not spending the sales taxes that you're collecting from clients and customers. And in terms of goals, like look at your short term, long term. I'm not a long term person because I feel like every time I've made a plan ever since I was, a teenager, oh, 10 years from now I want to do this. It never happens. Life
Not the way you
always
plan.
life always changes. Always changes. I wanted to be a partner at PwC when I started, and asked me to be a partnership of anything that I don't have control of. No, I don't want to be a partner, because to be a partner in a public accounting firm, that means that I'm going to be like 50 and I just became a partner. It happens early. I don't want to bash anything, but that's what it looked like for me then. And I had to be old and gray in order to be a partner. So that changed. I could never start a company. Go work for someone and say, hey, I want to be a partner. It's a goal that I had 10 years from, and it didn't work out. So I'm more like a short term. The most I'll plan up to is 5 years. In terms of goal, again, as a business owner, ask yourself, do you want a lifestyle company, whereas the company is just paying for your lifestyle? Or do you want to put this company in the best shape so you can sell it 5 years down the road? And what does that look like? There's a thing called exit strategy planning that I work close with. One of my close friends who is a financial advisor, he does this type of exit strategy plan for selling your company. Do you want to pass it down? I have not a one-man shop, but I have a specific skill that I do. I can't pass down this to anyone unless they express a desire that they want to do exactly what I'm doing if I have a kid. You know what I mean? So what am I doing this for? Like, how long I want to do this for? And it could take, do I want to do taxes for the rest of my life? I like what I do, but I don't want to be pushing paper until I'm like old and gray. I would like to, do other things, like do speaking engagement, stuff like that. So how does that look for my business? I have to plan around that. And your 5-year plan needs to trickle down all the way down to today and get detailed. And all that goes into just setting your goals. Be broad, get detail, how you're gonna implement it. When have you attained that in terms of dollars, and when have you attained that in terms of time? And that's pretty much it where you start. And I knew someone was going to ask me about tax planning. This is what it is. It's an analysis of financial situation or a plan from a tax perspective. It is an essential part for your financial planning. People do financial planning in terms of their finances with their financial advisor, but they don't do one for tax planning. And it's this basic strategies that's aimed to reduce the amount of taxable income. And therefore you reduce your tax liability.
Yeah.
So that's what it's designed to. You can't plan to reduce anything once the taxes are due. You have to do it now. Sometimes you could do it in December for that particular year if you implement it. I remember when the tax laws changed, everyone that had a home rushed to go make a payment. So that was their planning strategy because they had that time, because they would have lose it in the next year, which is this year and this past. So, it's to ensure tax efficiency. Make sure you're not paying taxes that you really don't need to. Is again with the tax reform, taking advantage of it, taking advantage of that 20%. Does it make sense to switch to a corporation? Because it's always been overall a no-brainer to be an S corporation. Now people are finding it's better to be a C corp based on the amount of money they're making. Not everyone makes sense, but for some of us it does. And then again, choosing the right entity, like we mentioned before, and just restructuring things. Especially if you have numerous corporations, numerous entities, and they kind of feed off each other and they intertwine. Sometimes structuring that and being more efficient in your tax obligations, does really help. And that's what we do tax planning for the most part. So yeah, I know we've been talking before, so any questions?
Well, thank you.
You're welcome.